Hey guys, it's Sasha. 100% of my investing portfolio at the moment is in US stocks. The majority of my investments are in individual US companies, but I also own a chunk of the S&P 500 and a bit of the Nasdaq 100 index. And there is a common thesis out there that this approach is a really bad idea because investing in the market of just one country leaves you with a massive risk if that one country's stock market underperforms. Just because the US stock market has overperformed the rest of the world in the past does not mean that it will outperform them in the future. In fact, the kind of accepted wisdom is that the opposite is more likely to be true. And if you only invest in the US stock market, then when the stock market of another country explodes, you will miss that opportunity. And this is why there is a popular assumption that investing in the total world index is the smarter strategy. You should stop trying to beat the market because 95% of people will fail at it anyway, and just take whatever amount of money that you have to invest every month and stick it into VT, the Vanguard Total World Stock Market Index, or a similar ETF if you don't live in the United States. And I don't share that opinion. But it's not that I don't share it because I'm some kind of a United States fanboy. I was born and grew up in Russia, and I lived most of my life in the UK. I only lived in New York for a relatively short period of time. In fact, there is a very specific reason why I only invest in US stocks, and as with all of my investing decisions, the reason is based on data and analysis. So given the prevailing consensus is that investing only in US stocks is a dumb idea, I thought I'd share some thoughts on why I do it, and why I think it is actually better than investing in the total world stock index. Just remember, I am here sharing my analysis and my personal opinion. I am not your financial advisor, and I'm not telling you what you should do, so please take it for what it is, a random guy on YouTube sharing his thoughts. Now, many arguments against only investing in US stocks bring up the example of Japan, because Japan had a booming, explosive stock market in the 1980s that resulted in the top 4 of the world's biggest companies in 1989 to be Japanese. In fact, 13 of the top 20 biggest companies by market cap were Japanese, and only 6 were from the United States. The Nikkei, which is the index for the Tokyo Stock Exchange in Japan, exploded in the 80s, going up by around 500%, and it peaked in 1989. And then the Japanese stock market collapsed, and Japan has had 30 years since then where the stock market hasn't reached its 1989 peak. This period is commonly known as the lost decades. And the popular argument is that the US stock market is doing something similar and risks having the same thing happen there as well. It's been going up like crazy for the last 10 years if you ignore this year so far, and some people say that the US stock market is in a giant bubble. So why would you want to go and invest in this bubble? Why would you put your money into US stocks? Well, look back at the list of the largest companies in Japan in 1989. You have the Industrial Bank of Japan, a Japanese bank operating in Japan. You have Sumitomo Bank, a Japanese bank operating in Japan. You've got Fuji Bank, a Japanese bank operating in Japan. And you'll never guess where this is going. Daiichi Kangyo Bank, a Japanese bank operating in Japan. And even if you look further down the list, the companies that were dominating the Japanese stock market were based in Japan and operated almost exclusively inside Japan. Some of them, like Toyota or Hitachi, exported products manufactured in Japan. But if you invested in the Japanese stock market in 1989, you were investing in companies based in Japan, operating in Japan, earning almost all of their revenue in Japan, and contributing exclusively to the Japanese GDP. The same was largely true in the United States. You can see that the largest companies in the US in 1989 were ExxonMobil, which operated mostly in the US, and others like General Electric and AT&T, which were also almost exclusively US domiciled commercially. But you could already see a glimmer of difference here because companies like IBM and Philip Morris were much more international. They would operate, produce, and sell their products much more globally, and if you invested in those companies, you were not really banking on just the US economy or just the US stock market. If people in Asia, Europe, Africa, South America, Australia, wherever bought more products from those companies because their economies were booming, you would also benefit as a shareholder. Fast forward just 10 years to 1999. The Japanese stock market has collapsed, lost the vast majority of its value, and only 2 Japanese companies were in the top 20, and interestingly, only one of them was in the same list 10 years earlier, and that is Toyota, the only one from the previous list that was genuinely operating globally outside of Japan and selling their cars around the world. In fact, while the Japanese stock market crumbled, Toyota's market cap increased by 240% in 10 years, a solid 13% annual rate of growth, while the entire stock market in Japan went down the toilet. But notice what changed at the top of this list. Gone are the big banks, income companies that happen to trade on the US stock exchange but run a global business selling to people all over the world. Microsoft topped the list in 1999. But the transition was not complete. It was just starting. Walmart was still at number 4 and operated almost exclusively within the United States and Canada. ExxonMobil was very heavily US-centric, etc., etc. But look at the biggest companies in the world today. Most of them are based in the United States and trade on US stock exchanges. But look at what it is that they do and how they do it. Apple, sell products and services in every country around the world. Microsoft, sell products and services in every country around the world. Alphabet, aka Google, sell their products and services in every country around the world. There is a very important difference today to 1989 or any other time in the past. The global economy has transformed to a point where a company can be based wherever it likes, but operate on a truly global scale, something that was nigh on impossible 30 years ago. The biggest companies in the world do not operate in closed markets within just one country. They are global leaders in what they do. In fact, they effectively take from the GDPs of every country around the world that they operate in and convert it into shareholder value within the US stock market. And not only that, but while many of these companies have pretty much saturated the US market, or at least developed to a point where it is incredibly competitive, they are still in many cases in very early stages of growth globally. Google's advertising business, for example, which is the main source of revenue for Google or Alphabet, earns pennies from most countries outside the United States compared to the rates that they are able to charge within the US. This is because the US is a much wealthier country and because the ad business is much more advanced within the US than in many countries and places like Asia or Africa. And over the next few decades, you would probably naturally expect, at least people investing in VT would probably expect, that those countries are going to play catch up like they have been doing up to now. Countries like India will have more and more people climb out of poverty, and they will become a dominant global economic powerhouse in the years to come. I'm certain that that will happen. And as that happens, the behemoths that have established themselves as the age of the internet arrived are going to collect a lot more money from those markets. Now, sure, there will be companies based in India or Indonesia or Brazil, wherever, that will also do well as their countries develop further. And some would argue that they may outperform the United States. But I see the opposite happening on average. While some of those companies will shoot through and deliver exceptional results, the world is shrinking and becoming smaller for companies to operate in. And I see the likes of Google, Microsoft, and Apple significantly increase their earnings from outside the US, as well as other US companies, as other countries grow faster. In fact, this is already happening. If you look at the commercial growth outside the US for all of these companies, it is increasing at a much faster rate than inside the US. These companies all just happen to be based in the US, mostly centered around a few tech hubs like Silicon Valley in California, and this is really important because these companies take their pick of the best engineers, the smartest scientists, the best workers from all over the world. Many of the smartest young people from countries like India, China, Malaysia, or Brazil dream of going to work at a Silicon Valley company in California and eventually get there. This means that there is a big drain on brains from those places towards the US stock market. There is a concentration of talent that is massively skewed at the moment to the United States. The vast majority of the funding for new businesses and for growing companies is also based in the United States, and this is creating a self-fulfilling spiral. Because in order to sell the leading software or the leading tech in India, you don't have to live in India like you did 30 years ago. You need to be based in Palo Alto. And yes, over the long term, this sort of thing can and probably will change. I am aware that India has very successful tech hubs with very smart people working there, and so do many other countries around the world. But I also don't think this transition is anywhere near the peak. I think it's only just getting started. I think the next 20 years will continue to see the world shrink in the way that commerce works, and we'll continue to see global leaders outmuscle and outcompete inferior offerings by local providers in cases where the product or service does not have to be provided locally. And there is one market in the world which happens to have the most existing technology leaders, most of the world's best brainpower, and most of the world's funding, and that market is the United States. Now, I don't actually invest in US companies because they are based in the US. This is probably the most interesting point that underscores the whole point that I am making. I am completely agnostic on that front. If Google was based in Antarctica, I would still invest in Google. The fact is, I invest in companies where I believe there is an exceptionally high potential for growth in the next 10 to 20 years. And it just so happens that although I look frequently at companies in the UK, across Europe, in Asia, the most exciting prospects from my personal perspective just happen to be based in the United States, probably because of the reasons I just outlined. And this is why I continue to be invested in the US stock market so heavily and don't share the view that it is necessarily a dumb thing to do. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.